My name is Alex Morgan, and today we're breaking down one of the most important battles happening in the financial markets right now, the fight between gold and the US dollar. If you've been watching the markets closely, you already know something unusual is happening. Gold prices are holding near record territory, while the US dollar is struggling to assert dominance, even with strong economic data still coming out of the United States. This isn't just another short-term fluctuation. This is a structural shift that investors around the world are paying very close attention to. Right now, gold in the US market is trading near historically elevated levels, hovering just above the psychologically critical zone that traders have been watching closely for weeks. Every time gold dips, buyers step in aggressively. That tells us something important. This market isn't being driven by emotion alone. It's being driven by capital repositioning. At the same time, the US dollar index, which measures the dollar against a basket of major global currencies, has been showing signs of fatigue. Even when it bounces, those moves are increasingly short-lived. To understand who's really winning right now, gold or the US dollar, we need to zoom out and look at the forces driving both markets simultaneously. Gold and the dollar have historically shared an inverse relationship. When the dollar strengthens, gold usually weakens, and when the dollar weakens, gold tends to rise. But what makes today's environment different is that gold is strong even when the dollar isn't collapsing. That tells us this is not just a currency trade. This is a confidence trade. The US dollar is still the world's reserve currency. That hasn't changed. But reserve currency status doesn't mean immunity from pressure. Investors are increasingly questioning long-term fiscal discipline, rising debt servicing costs, and the sustainability of current monetary policies. Even when US economic data looks solid on the surface, markets are forward-looking. They don't price today, they price the future. Interest rates are a perfect example. For a long time, higher US interest rates supported the dollar and pressured gold. But now, even with rates elevated, gold remains strong. Why? Because real yields, the yield after accounting for inflation, are no longer providing the same level of confidence. Inflation expectations remain sticky, and that reduces the attractiveness of holding cash or dollar-denominated assets long-term. Another critical factor is global demand. Central banks around the world continue to accumulate gold at a pace that would have been unthinkable a decade ago. This isn't speculative buying. This is strategic buying. When central banks increase gold reserves, they are signaling a desire to diversify away from currency exposure, particularly dollar exposure. That doesn't mean the dollar is collapsing tomorrow, but it does mean gold is being reestablished as a monetary asset, not just a commodity. In the US market today, traders are closely watching upcoming economic data, especially inflation reports, labor market numbers, and any guidance coming from the Federal Reserve. Strong data tends to support the dollar in the short term, but there's a catch. Strong data also reduces the likelihood of rate cuts, which can tighten financial conditions and increase systemic risk. When risk rises, gold benefits. This is why gold rallies are becoming more resilient. Let's talk about market positioning. Futures data shows that institutional players are not exiting gold positions aggressively, even after sharp rallies. Instead, we're seeing consolidation above key support zones. That suggests confidence, not fear. Meanwhile, dollar positioning has become more tactical. Traders are quick to buy dips, but even quicker to take profits. That's not how a dominant currency behaves during a strong trend. Now here's where things get really interesting. Gold isn't just reacting to the US dollar. It's reacting to geopolitical risk, trade fragmentation, and long-term structural shifts in the global economy. When countries talk about settling trade in local currencies, when sanctions reshape payment systems, and when global supply chains realign, gold quietly benefits. It doesn't need permission. It doesn't rely on trust. It simply exists. So who's winning today? In the short term, the US dollar still has moments of strength, especially during risk-off events or strong data surprises. But in the broader picture, gold is winning the confidence war. It's absorbing pressure, holding value, and attracting long-term capital. Looking ahead, what could happen next depends on a few key scenarios. If US inflation comes in hotter than expected, the dollar may spike briefly, but gold could actually rise alongside it if markets interpret that data as a policy risk rather than a growth signal. If inflation cools faster than expected, the dollar may weaken as rate cut expectations increase, which would be bullish for gold. Either way, gold has support. The real risk to gold would be a sustained period of disinflation combined with strong real economic growth and fiscal discipline. Right now, that scenario looks unlikely. Debt levels remain high, deficits continue to expand, and geopolitical uncertainty isn't going away. That's why long-term investors are not rushing to exit gold positions. Now let's bring silver into this conversation, because silver often tells us where the metals market is headed next. Silver is not just a precious metal, it's also an industrial metal. That gives it a unique dual role. When economic optimism rises, silver benefits from industrial demand. When monetary uncertainty rises, silver benefits from precious metal demand. Right now, silver has been lagging gold, and that's normal during the early stages of a precious metals rally. Gold usually leads, and silver follows with more volatility. But historically, when silver starts to catch up, it often outperforms gold on a percentage basis. That's something investors are watching very closely. If gold continues to hold above key support levels and the US dollar fails to establish a strong upward trend, silver could be setting up for a delayed breakout. Industrial demand tied to renewable energy, electronics, and infrastructure remains strong, while above-ground silver inventories are not growing at the same pace as demand. That imbalance matters. In the near term, silver may experience sharp pullbacks. It's a thinner market and more sensitive to risk sentiment. But if the macro environment continues to favor hard assets over fiat confidence, silver could move aggressively higher once momentum builds. Historically, silver rallies tend to be fast and emotional. When they start, they don't give many second chances. So the big picture is this. The US dollar is still powerful, but it's no longer unchallenged in the way it once was. Gold is no longer just a hedge, it's becoming a statement about trust, stability, and long-term value. And silver is waiting in the background, quietly building pressure. If you're watching this market, don't just focus on daily price moves. Watch how gold behaves when the dollar rises. Watch how silver reacts when gold consolidates. Those relationships tell you more than any single headline ever could. We're living in a period where financial markets are being reshaped in real time. The gold versus US dollar story is not about winning today, it's about positioning for what comes next. And what comes next may redefine how value is measured in the global system. If you found this breakdown helpful and you want clear, data-driven analysis on gold, silver, the US dollar, and the broader financial markets, make sure you subscribe to the channel. Turn on notifications so you don't miss upcoming market updates, and drop a comment below with your thoughts on where gold and silver are headed next. This is Alex Morgan, and I'll see you in the next video.